Wait, before you skip or scroll, watch this video till the very end, because this might be the one video that finally turns you into a profitable trader. I am not joking. If even for a second you feel like this video added zero value to your trading journey, just drop a comment. I will delete the video myself. No excuses, no questions asked. Now let us not waste time. Let us get started. Market structure and trend basics. So before we go deep, you need to understand market structure. There are three types of markets. The first type is higher highs and higher lows. This shows an uptrend. The second is lower lows and lower highs. This shows a downtrend. And the third is sideways or range bound. Never trade this third type. Avoid this zone. Fibonacci works best when there is a clear trend because pullbacks respect Fibonacci levels. In sideways markets, there is no clear impulse or retracement. Price disrespects levels. You get trapped easily. So only apply Fibonacci when the market is trending either up or down, not when the market is stuck or indecisive. Because in trending markets, Fibonacci levels give clean pullbacks, and those give accurate entries. Why Fibonacci works. Millions of traders use Fibonacci. And that is exactly what makes it powerful. Now here is how to set up the Fibonacci tool on TradingView. Click the third icon on the left and choose Fibonacci retracement. Now open the settings. Turn on only these levels. This setup clears out the noise. Your entry zones are now clean, visible, and accurate. Let us break this down step by step. In a bullish trend, start at the lowest point. That is your swing low. Now drag the Fibonacci tool to the highest point. That is your swing high. In a bearish trend, start at the highest point, the swing high. Drag down to the lowest point, the swing low. That is the swing you want to measure with Fibonacci. Alright, these are the most powerful zones. 0.5, because many pullbacks naturally retrace around half of the move before continuing. 0.618, this is the golden ratio. It comes directly from the Fibonacci sequence. In trading, this level acts as strong support and resistance during a trend. When price hits the golden pocket between 0.5 and 0.618, the market pauses. It decides, should I continue the trend or should I reverse? Let me share something important. Most of the time, when the market moves fast, creating big candles, it quickly touches the 0.5 Fibonacci level. Why? Because those big moves are often designed to hunt liquidity, to trigger stop losses and grab pending orders. And when price hits the 0.5 level with force, there is a high probability of a strong reaction from that level. But if the market approaches the 0.5 level slowly, with small candles, it usually breaks below 0.5 and reacts from the 0.618 level instead. So always remember, if price comes in fast with big candles, the 0.5 level acts stronger. If price comes in slow and weak, expect a deeper pullback to the 0.618 level. This small difference can completely change your entry timing and accuracy. Do not trade this strategy on noisy charts. Use 15-minute to 1-hour time frames. These time frames remove small fake candles and manipulative moves. They help you see the real trend. Avoid 1-minute or 5-minute time frames. They are full of fakeouts and noise. Now add a 50 EMA to your chart. If the current price stays above the 50 EMA, it signals a bullish market condition. That means buyers are in control. The market is likely to move upward, so look for buy setups in those conditions. If the price stays below the 50 EMA, it indicates a bearish trend. Sellers are dominant, and the market is likely to move downward. In that case, look for sell setups. This simple filter helps confirm that you are trading in the right direction. Especially for beginners, this adds confidence and clarity. Now let's go through a few examples so you can understand this better. The market is currently forming higher lows, which clearly shows that it is in an uptrend. If you want extra confirmation, you can also use the 50 EMA. Let me explain something important. Whenever the market takes a pullback, we draw our Fibonacci retracement up to that point. However, if the market breaks the structure from there, we then shift our Fibonacci to the next high. Instead, it is coming down for a retracement. Here, it has touched the 0.5 Fibonacci level with a strong candle and even slightly broken it. Our next step will be to wait for the next candle. If a hammer or an engulfing candle forms, or if price action shows rejection, we will take the trade. Based on the current setup, there is a strong indication that the 0.5 level will hold, with about a 95% probability of working in our favor. Once the trade is entered, our target will be set at the next high. In this example, you can clearly see that the market is moving in a higher high and higher low formation. Here, we will draw a Fibonacci retracement from the recent low point to the top point. Looking at the rally, you can see that the market broke the 0.5 Fibonacci level with a smaller candle. As I have explained earlier, whenever the 0.5 level is broken by a small candle, it often indicates that the market might disrespect this level. In such cases, it's better not to enter a trade immediately. Instead, we wait for the market to break the 0.5 level to the upside with a strong bullish candle. This gives us confirmation that the 0.5 level could still hold. However, another approach is to wait for the market to reach the 0.618 level and form a valid rejection pattern. In this scenario, the market touched the 0.618 level and formed a clear rejection. This is our entry signal, and our trade target will be set at the next high. Remember, no setup works 100% of the time. That is why it is important to keep these points in mind and follow the rules I have shared with you earlier. Take a screenshot of this example and keep it in mind whenever you trade. If you found this video informative, make sure to like it, comment below to let me know what topic you would like me to cover next, and subscribe to the channel so I can keep bringing you more valuable trading lessons.